I started investing in 1975. I was 26 years old, fresh out of business school, convinced I knew how markets worked. I didn't. Over the next 50 years, I made every mistake you can imagine. I went broke in 1982. I missed opportunities. I overestimated my abilities. I underestimated risks. But through all of that, through the successes, and especially through the failures, I learned. And that's what I want to share with you today. The biggest lessons from 50 years of investing. Not theories from textbooks, not academic models, but real, battle-tested wisdom earned through decades of actual experience in markets. I've navigated the 1970s stagflation, the 1987 crash, the 1990s tech boom and 2000 bust, the 2008 financial crisis, the 2020 COVID crash, the 2022 inflation spike, and everything in between. I've managed money through 8 recessions, 5 major market crashes, countless geopolitical crises, and more volatility than I can count. And through it all, certain lessons kept revealing themselves. Patterns that repeated, principles that held true across decades and across completely different market environments. Today, I want to share the 10 most important lessons. These aren't equally weighted. Some are more fundamental than others. But all of them have shaped how I think about investing, risk, and building wealth. The 10 lessons. You don't know as much as you think you do. Pain plus reflection equals progress. Diversification is the only free lunch. Understand the machine. Radical open-mindedness beats intelligence. The biggest risk is being wrong and not knowing it. Make more good decisions than bad ones. Everything is a trade-off. Bet on people, not just ideas. Time in the market, timing the market. These lessons aren't just about making money. They're about thinking clearly, making better decisions, and navigating uncertainty. They apply to investing, but also to business, relationships, and life. Let me walk you through each one. Lesson number 1. You don't know as much as you think you do. This is the foundation. The most important lesson. Everything else builds on this. My 1982 story. In 1982, I was absolutely certain, 100% confident, that the U.S. economy was heading into a depression. I had done my analysis. I had my models. I had thought through all the scenarios. I went on TV and predicted economic catastrophe. I advised clients to position defensively. I bet my own money on my thesis. And I was completely, utterly, devastatingly wrong. The economy didn't collapse. It boomed. Mexico didn't default the way I expected. The debt crisis resolved differently than I predicted. And I lost everything. I had to borrow $4,000 from my dad to pay my bills. Well, I learned. My biggest risk wasn't that I was wrong. It's that I was wrong and didn't know it. I was so confident in my analysis that I didn't consider the possibility that I might be missing something. The intellectual humility principle. Since 1982, I've operated from a position of intellectual humility. I assume that I'm probably wrong about something important. I actively look for ways my thinking could be flawed. I seek out people who disagree with me. This doesn't mean I don't have views or convictions. It means I hold those views probabilistically, not absolutely. Instead of thinking, I know the market will crash, 100% certain. I believe there's a 60% chance of recession in the next 12 months, but I could be wrong, probabilistic. How this changes behavior. When you acknowledge you might be wrong, you diversify because no single bet is certain. You stress test your ideas, looking for holes. You seek disagreement to find your blind spots. You adjust when new data arrives, instead of stubbornly sticking to original thesis. The paradox. Acknowledging you don't know as much as you think actually makes you a better investor. Because you take less concentrated risk, learn faster, adapt more quickly, avoid catastrophic mistakes. Application. Before making any significant investment decision, ask yourself, what am I assuming that might be wrong? What would have to be true for the opposite to happen? Who smart disagrees with me, and why? This is lesson number 1, and it's foundational to everything else. Lesson number 2, pain plus reflection equals progress. I've learned more from my failures than from my successes. And the mechanism is simple. Pain plus reflection equals progress. Pain alone doesn't teach you anything. You can fail, feel bad, and move on without learning. That's just suffering. But pain plus reflection, pain plus asking, what can I learn from this? That's where growth happens. The mechanism. Step 1. Experience pain, failure, loss, mistake. Step 2. Resist the urge to avoid thinking about it. Your natural instinct is to move on quickly, distract yourself, rationalize the failure. Resist this. Step 3. Reflect deeply. What exactly happened? What was I trying to achieve? What did my thinking go wrong? What assumptions were incorrect? What can I do differently next time? Step 4. Extract the principle. Turn the specific lesson into a general rule you can apply in the future. Step 5. Test the principle. The next time you're in a similar situation, apply the principle. Does it work? Refine it based on results. Examples from my career. Failure. 1982 bankruptcy reflection. I was overconfident, didn't stress test thesis, ignored contrary evidence principle. Seek out smart people who disagree with you application. Build culture at Bridgewater where disagreement is required failure. Missing technology boom in 1990s, underperformed reflection. I dismissed new economy as bubble without understanding underlying fundamentals principle. Don't let your worldview prevent you from seeing what's actually happening application. Stay intellectually flexible. Distinguish between bubble and fundamental change failure. Various investment losses reflection. Wasn't diversified enough, had blind spots, relied too much on single scenarios principle. Diversify. Across uncorrelated strategies application. Built all-weather portfolio approach lesson number 3. Diversification is the only free lunch in 50 years of investing. I've learned there are very few free lunches in markets. But pain plus reflection, pain plus asking, what can I learn from this? That's where growth happens. The mechanism. Step 1. Experience pain, failure, loss, mistake. Step 2. Resist the urge to avoid thinking about it. Your natural instinct is to move on quickly, distract yourself, rationalize the failure. Resist this. Step 3. Reflect deeply. What exactly happened? What was I trying to achieve? What did my thinking go wrong? What assumptions were incorrect? What can I do differently next time? Step 4. Extract the principle. Turn the specific lesson into a general rule you can apply in the future. Step 5. Test the principle. The next time you're in a similar situation, apply the principle. Does it work? Refine it based on results. Almost everything is a trade-off. You give up something to get something else. But diversification is the exception. It's the one genuine free lunch. You can reduce risk without reducing returns. Why diversification works. Different assets perform well in different environments. Stocks do well when economy grows, rising corporate earnings. Bonds do well when economy slows or contracts, rates fall. Gold does well when currencies are debasing or geopolitical stress. Commodities do well when inflation accelerates. Because these assets are driven by different forces, they don't all move together. When one is down, another might be up. The math of diversification. Let's say you have two assets. Asset A returns 10% with volatility, risk of 20%. Asset B returns 10% with volatility of 20%. If you put 100% in asset A, you get 10% return with 20% risk. But if you put 50% in A and 50% in B, and they're uncorrelated, don't move together, you still get roughly 10% return, but your risk drops to about 14%. Same return, lower risk. That's a free lunch. My biggest mistake early on. In my 20s and 30s, I occasionally made concentrated bets. When I was right, I made a lot of money. But when I was wrong, like 1982, I lost everything. I learned, never bet so much on any single outcome that if you're wrong, you're finished. The all-weather portfolio. This lesson led me to create the all-weather portfolio in the 1990s. The idea: structure a portfolio that performs reasonably well across all economic environments, growth, recession, inflation, deflation. Basic allocation: 30% stocks, 40% long-term bonds, 15% intermediate bonds, 7.5% gold, 7.5% commodities, This portfolio has never had a year worse than -4% since 1984. Not because it avoids risk, but because different assets balance each other. Beyond asset diversification, diversification applies to more than just assets. Geographic diversification. Don't put everything in one country. Sector diversification. Don't put everything in one industry. Strategy diversification. Don't rely on one investment approach. Time diversification. Don't put all capital to work at once. Dollar cost average. The psychological benefit. Diversification also helps psychologically. When one part of your portfolio is down, another part is usually up. This makes it easier to stay disciplined and not panic sell at bottoms. The limit of diversification. There is such a thing as over-diversification. If you own 500 stocks across every sector and every geography, you're basically just owning the market and will get market returns. The sweet spot is typically 15 to 25 positions that are truly uncorrelated. Beyond that, you get diminishing benefits. Application. Review your portfolio. Are you over-concentrated in any single asset, sector, geography, or strategy? What would happen if your biggest position went to zero? Would you be okay? Can you add uncorrelated assets to reduce overall portfolio risk? Diversification is the closest thing to free money in investing. Use it. Lesson number 4. Understand the machine. One of the most important insights from 50 years is this. Everything is a machine. A system with inputs, processes, and outputs. Cause and effect. If you understand how the machine works, you can predict how it will behave and make better decisions. The economic machine. Over decades, I've studied how economies work, and I've distilled it down to a relatively simple framework. The 3 main forces. 1. Productivity growth, long-term driver, grows about 2% per year. 2. The short-term debt cycle, 5 to 8 years, driven by credit expansion and contraction. 3. The long-term debt cycle, 50 to 75 years, driven by massive debt accumulation and deleveraging. Understanding these 3 forces explains almost every economic expansion, recession, boom, and bust over the last 100-plus years. Example: the 2008 financial crisis. If you understood the long-term debt cycle, 2008 was predictable. Private debt, mortgages, consumer credit had reached unsustainable levels. When debt can't be serviced, defaults happen. Defaults cause asset prices to fall. Falling asset prices make debt even harder to service. This creates a self-reinforcing downward spiral, deleveraging. I saw this coming because I understood the machine. I positioned defensively. Bridgewater was up 14% in 2008, while most funds were down 30 to 40%. The investment machine. Investing is also a machine. Inputs: your capital, your research, your time, your decisions. Process: how you analyze opportunities, how you manage risk, how you make decisions, how you handle emotions. Outputs: your returns, your risk-adjusted returns, your learning. If your outputs, returns, aren't what you want, don't just try harder. Examine the machine. Are the inputs wrong? Not enough research, wrong information. Is the process flawed? Poor decision-making framework, emotional decisions. Where's the bottleneck? Example: my investment process machine. Over 50 years, I've systematized my investment process. Input: economic data, market prices, geopolitical developments, expert opinions. Process: form hypothesis about how events will unfold. Stress test hypothesis: what could go wrong? Seek out people who disagree. Refine hypothesis based on feedback. Size position based on conviction and risk. Monitor for changes that would invalidate thesis. Output: investment decisions, track record, lessons learned. By treating this as a machine, I can identify where breakdowns occur and fix them. Application: for any system, investing, business relationships. Map out the inputs, processes, outputs. When outputs aren't what you want, diagnose the machine. Fix the broken part. Test to see if it works better. This systematic thinking has been critical to 50 years of continuous improvement. Lesson number 5. Radical open-mindedness beats intelligence. Over 50 years, I've worked with brilliant people. PhDs from top schools. People with 160 plus IQs. Geniuses. And I've learned something surprising. Intelligence matters, but radical open-mindedness matters more. What is radical open-mindedness? It's the ability to consider ideas that contradict your own views. Update your beliefs when presented with better evidence. Seek out people who disagree with you. Acknowledge when you don't know something. Change your mind when warranted. Why it matters more than intelligence. Scenario 1. High intelligence, low open-mindedness, brilliant analysis, strong conviction, but blind to contradictory evidence. Stubborn in face of new data. Makes catastrophic mistakes when wrong. Scenario 2. Moderate intelligence, high open-mindedness, decent analysis, provisional conviction, actively seeks contradictory evidence, updates quickly when wrong, avoids catastrophic mistakes, compounds learning. Over time, person number 2 outperforms person number 1 because markets are complex and uncertain. No one is smart enough to always be right, but you can be open-minded enough to correct mistakes quickly. My example, in the 1990s, I was skeptical of the technology boom. I thought valuations were insane. I positioned for a crash, and I was partially right. There was a crash in 2000. But I was also wrong because I underestimated the genuine transformative power of the internet. If I had been radically open-minded, I would have sought out tech bulls and listened seriously to their arguments, distinguished between bubble, overvaluation, and fundamental change, real innovation, participated in some of the genuine opportunity while hedging the bubble risk. People are required to disagree with each other, regardless of hierarchy. Meetings are recorded and reviewed to identify thinking errors. We have a believability-weighted decision-making system. Not everyone's opinion is equal, but everyone's opinion is heard. This culture has been a competitive advantage. Application. On your next investment decision, find 3 smart people who would disagree. Listen seriously to their reasoning. Steelman their argument. Present it as strongly as possible. Now make your decision. You'll either become more confident because you've tested the idea, or you'll change your mind because you found a flaw. Either way, you're better off. Lesson number 6. The biggest risk is being wrong and not knowing it. This builds on lesson number 1, but deserves its own section because it's so important. The obvious risks everyone worries about. Market crash, recession, inflation, geopolitical crisis. The real risk almost no one worries about. Being wrong about your assessment. Having blind spots you can't see. Operating on false assumptions. Overconfidence in flawed analysis. Why this is the biggest risk. If you know you're taking a risk, you can manage it. You can size the position appropriately. You can hedge. You can set stop losses. You can prepare for different scenarios. But if you don't know you're wrong, you can't manage the risk. You'll make concentrated bets on flawed theses. You'll be blindsided when reality doesn't match your expectations. My 1982 lesson, again. I didn't lose money because markets are risky. I lost money because I was wrong and didn't know it. I was so confident that I didn't even consider the possibility of being wrong. How to protect against this risk. Strategy 1. Assume you're wrong about something. Before making any major decision, literally say out loud, I'm probably wrong about something important here. What might it be? Strategy 2. Pre-mortem analysis. Imagine it's 1 year in the future and your investment has failed catastrophically. Write down all the reasons why it might have failed. This forces you to think through what you might be missing. Strategy 3. Devil's advocate. Assign someone, or play the role yourself, to argue forcefully against your thesis. Make the strongest possible case for why you're wrong. Strategy 4. Scenario planning. Don't just plan for your base case. Plan for optimistic case. What if things go better than expected? Pessimistic case. What if things go worse? Alternative case. What if something completely different happens? For each scenario, ask, how would I know if this scenario is unfolding? And what would I do? Strategy 5. Diversification again. If you knew with certainty which investment would perform best, you'd put 100% there. The fact that you diversify is an admission that you don't know for certain. Embrace that. The intellectual humility loop. Make investment thesis. Acknowledge you might be wrong. Identify what would prove you wrong. Monitor for those signals. When signals appear, update thesis. Repeat. This loop has saved me from countless catastrophic mistakes over 50 years. Application. For your current portfolio, ask, what am I assuming that might be wrong? What would have to happen for my biggest position to fail? Am I diversified enough to survive being wrong about my highest conviction idea? The biggest risk is always the one you don't see. Stay humble. Lesson number 7. Make more good decisions than bad ones. This sounds obvious, but it's profound. You don't need to be right all the time. You just need to be right more often than wrong. The math. If you make 100 investment decisions, 60 are good, make money. 40 are bad, lose money. You'll be profitable overall, even though you were wrong 40% of the time. The key variables. 1. Win rate, percent of decisions that are correct. 2. Magnitude of wins versus losses. How much you make when right versus lose when wrong. You can be profitable with a low win rate if your wins are much bigger than your losses. Or you can be profitable with a high win rate, even if wins and losses are similar size. Examples. Strategy A. High win rate, small wins. 70% of trades win. Average win, plus 5%. Average loss, minus 3%. Result, profitable. Strategy B. Low win rate, big wins. 40% of trades win. Average win, plus 25%. Average loss, minus 8%. Result, also profitable, possibly more profitable. What doesn't work? Strategy C. Low win rate, small wins. 40% win rate. Average win, plus 5%. Average loss, minus 8%. Result, you go broke. How to improve your win rate. Tactic 1. Process over outcomes. Focus on making good decisions, not on whether any single decision works out. Even good decisions sometimes have bad outcomes due to luck. Over time, good process yields good results. Tactic 2. Learn from mistakes. Every bad decision is data. What went wrong? Why? What do you do differently? This is the pain plus reflection equals progress loop. Tactic 3. Play to your strengths. You'll have higher win rates in areas where you have genuine edge, knowledge, experience, access, analytical ability. Don't make decisions in areas where you have no edge. Tactic 4. Size positions based on conviction. When you have high conviction and have stress-tested the idea, bet bigger. When conviction is lower, bet smaller. This improves the magnitude side of the equation. My track record. Over 50 years at Bridgewater, we haven't been right all the time. We've had plenty of losing years in individual strategies. But our all-weather portfolio, positive 42 out of 43 years since 1984. Our overall track record, consistently positive over decades. Why? Because we have a robust process. Diversify, so single mistakes don't destroy us. Learn from failures. Make slightly more good decisions than bad. Application. Track your decisions over time. Keep a journal of investment decisions. Record your reasoning at the time. Later, analyze. Was the reasoning sound? What happened? What did you learn? Calculate your win rate and average win/loss size. Work on improving both. You don't need to be perfect. You need to be good enough consistently. Lesson number 8. Bet on people, not just ideas. Over 50 years, I've learned that people matter more than ideas. A great idea with mediocre execution fails. A decent idea with great execution succeeds. Why people matter? Markets change. The strategy that worked in the 1980s doesn't work in the 2020s. People who can adapt succeed. Those who can't fail. Execution is everything. Knowing what to do is 20% of success. Actually doing it, having the discipline, patience, emotional control, and persistence is 80%. Learning compounds. People who learn from mistakes get better over time. People who don't stagnate. Character matters. In crisis, people's true character emerges. You want people who Stay calm under pressure. Think clearly when others panic. Admit mistakes quickly. Have integrity, don't cut corners. How I evaluate people. When hiring for Bridgewater or allocating capital to other managers, I look for 1. Track record, but understanding context. Not just did they make money, but how did they make it? And is it repeatable? 2. Thinking process. Can they explain their reasoning clearly? Do they understand cause and effect? Are they intellectually rigorous? 3. Learning ability. How do they handle mistakes? Do they reflect and improve, or repeat the same errors? 4. Character. Are they honest about their limitations? Do they take responsibility? Can you trust them? 5. Cultural fit. At Bridgewater, we need people who embrace radical truth and transparency. Brilliant people who can't handle disagreement don't work here, regardless of talent. Examples from my career. Best decisions. Hiring people who were intellectually humble, great learners, high character. Even when they made mistakes, they learned fast and became exceptional. Worst decisions. Hiring people based purely on intelligence or credentials without assessing character, learning ability, or cultural fit. Often ended badly even when they were technically brilliant. Application to investing. When investing in companies, look at management. Do they have integrity? Do they learn from mistakes? Do they communicate honestly with shareholders? Have they executed well over time? Great management can take a mediocre business and make it excellent. Bad management can take a great business and destroy it. When allocating to fund managers, don't just look at past returns. Understand, how do they generate those returns? How do they think? What's their investment philosophy? How do they handle adversity? Application. For your next investment decision, if investing in a company, research management extensively. If allocating to a fund, interview the manager if possible. If hiring a financial advisor, assess character and process, not just credentials. Bet on people with strong character, learning ability, and good processes. Over time, they win. Lesson number 9. Time in the market, timing the market. The final lesson from 50 years. Time in the market beats timing the market. The temptation. Everyone wants to buy at the bottom and sell at the top. Get in before the rally. Get out before the crash. Perfect timing. The reality. I've been investing for 50 years. I predicted some moves correctly. I missed others. I've been early sometimes, late others. And here's what I've learned. You can't consistently time the market. Not me, not anyone. Even when you get the direction right, timing is nearly impossible. The market can stay irrational longer than you can stay solvent. It can crash after you've given up waiting for it. It can rally after you've sold. The power of time. Scenario A. Perfect timing impossible. Invest $100,000 at every market bottom for 30 years. Return 15% annualized. Ending wealth $6.6 million. Scenario B. Worst timing, unlucky. Invest $100,000 at every market peak for 30 years. Return 11% annualized. Ending wealth $2.3 million. Scenario C. Dollar cost averaging realistic. Invest $100,000 per year consistently regardless of market level. Return 13% annualized. Ending wealth $4.0 million. The lesson. Even with the worst possible timing, you still get $2.3 million from $100,000 because you stayed in the market. Time is more important than timing. My personal experience. I've stayed invested for 50 years through multiple crashes, 1987, 2000, 2008, 2020, multiple bull markets, wars, crises, pandemics, inflation, deflation. If I had tried to time all these, I would have. Missed rallies. Markets recover faster than expected. Re-entered too late, waiting for perfect entry. Underperformed, simply staying invested. The Bridgewater approach. We don't try to time entries and exits. Instead, we stay consistently invested across multiple strategies. We rebalance systematically, not emotionally. We focus on diversification and risk management. We compound over decades. This has worked better than trying to time. The exception. There's a difference between timing, trying to predict short-term, moves very hard. usually fails. Valuation awareness. Avoiding extremely overvalued assets, reasonable and valuable. I don't try to time when the market will peak, but I do avoid assets that are extremely overvalued relative to fundamentals. Application. For most investors, develop a sound strategy. Implement it consistently. Stay invested through volatility. Rebalance systematically, not emotionally. Compound over decades. Don't try to call market tops and bottoms. Move to cash waiting for a crash. Chase returns, buy after something has already rallied. Instead, invest consistently. Diversify broadly. Think in decades, not days. Let time do the work. My biggest regret, not that I missed some rallies or sold too early sometimes. It's that early in my career, I sometimes went to cash entirely, waiting for the right time to get back in. Those periods cost me years of compounding. Stay invested. Be patient. Time in the market beats timing the market. Let me bring all of this together. The 10 lessons from 50 years. You don't know as much as you think. Stay humble. Pain plus reflection equals progress. Learn from mistakes. Diversification is the only free lunch. Reduce risk without sacrificing returns. Understand the machine. Everything is cause and effect. Radical open-mindedness beats intelligence. Seek disagreement. The biggest risk is being wrong and not knowing it. Stress test your ideas. Make more good decisions than bad ones. Focus on process. Everything is a trade-off. Choose. Consciously bet on people, not just ideas. Character and learning matter. Time in a market, timing the market, stay invested, be patient. The meta lesson. All of these lessons point to a deeper truth. Investing is not primarily about intelligence or knowledge. Let me bring all of this together. It's about decision-making under uncertainty. The best investors acknowledge uncertainty. Lesson 1, 6. Learn continuously. Lesson 2, 5. Manage risk intelligently. Lesson 3, 8. Think systematically. Lesson 4, 7. Focus on people and process. Lesson 9. Have patience. Lesson 10. Why I wish I'd known at 26. If I could go back and tell my younger self one thing, it would be this. You're going to make a lot of mistakes. That's okay. The key is to learn from them systematically. Build principles from your experiences. Stay humble. Stay curious. And compound learning over decades. For you, you don't need 50 years to apply these lessons. You can start today. Acknowledge what you don't know. Seek out disagreement. Diversify broadly. Learn from mistakes. Stay invested. Think in decades. If you do these things consistently, you'll be far ahead of most investors. A final thought. The markets I entered in 1975 are gone. The markets of 2026 will be gone by 2050. Everything changes. But these lessons, rooted in human psychology, probability, and systematic thinking, they endure. Because while markets change, human nature doesn't. Fear and greed, overconfidence and panic, the desire for certainty in an uncertain world, these are constant. Master these lessons, and you'll navigate whatever markets throw at you. Thank you for watching. I hope these 50 years of lessons save you some pain and accelerate your own journey. Now go apply them.